Have you ever wondered how the influx of new apartments and international trade disputes can simultaneously impact the multifamily real estate market in Canada? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. In a recent report by Oxford Economics, the Canadian multifamily real estate market is facing pressures from two significant fronts: a surge in new apartment supply, and an ongoing trade war with the United States. According to the report, Canada's national average asking rent in May stood at $2,129 per month, marking a 3.3% decline from the same period last year. The cities experiencing the most notable decreases in apartment rents include Calgary, Vancouver, and Toronto, which are typically known for their bustling real estate markets. The report highlights that new multifamily unit completions surged by 35% in 2024, which has rapidly increased the supply in the market. Oxford Economics anticipates that this trend of strong rental supply growth will persist as a record number of purpose-built rental units are completed and absorbed into the existing housing stock. Despite the influx of new supply, the demand for rentals is expected to face challenges due to slower immigration and a reduction in temporary residents, which traditionally bolster demand. However, there's a silver lining. With homeownership affordability worsening and financial strains on households due to the trade war-induced recession, rental demand is likely to remain stable in the coming quarters. This provides a cushion against potential declines in rental occupancy rates. On the international stage, there have been tensions as United States President Donald Trump threatened to escalate the trade war over Canada's digital service tax on U.S. tech giants. Though Canadian Prime Minister Mark Carney's government has agreed to resume negotiations, the outcome remains uncertain, with a deadline set for July 21st. Tony Stillo, Director of Canadian Economics at Oxford Economics, suggests that unless an immediate resolution is reached to remove the tariffs, the housing slump is likely to persist through the end of 2025. Stillo also predicts that the resale housing market may struggle to recover due to poor affordability, weak consumer confidence, and job losses stemming from the recession. The reduced immigration rates are expected to further impact the sector, increasing the supply of homes for sale and potentially causing average prices to fall by 8 to 10% by year's end. CoStar Market Analytics provides additional insight, noting that market vacancy rates are approaching more balanced levels in high-cost urban areas like Toronto and Vancouver, while Alberta is seeing vacancy rates move towards cyclical highs. It's an interesting time for investors and stakeholders in the multifamily sector to evaluate their strategies and adapt to these evolving market conditions. In a significant move within the real estate investment landscape, Morgan Properties, a major player based just outside Philadelphia, has agreed to acquire Toronto-based Dream Residential Real Estate Investment Trust. This acquisition aims to expand Morgan Properties' holdings in the U.S., Midwest, and the rapidly growing Sunbelt regions. The transaction is valued at approximately $354 million US dollars, which concludes Dream Residential's strategic review. Unit holders are expected to receive $10.80 per unit, representing an 18% premium over the REIT's recent closing price, contingent upon stakeholder approval. The deal is projected to close by the end of this year. Dream Residential Real Estate Investment Trust, situated in downtown Toronto at 30 Adelaide East, boasts a portfolio of 15 properties with around 3,300 units. These are primarily garden-style apartment complexes located in metropolitan areas such as Dallas-Fort Worth, Oklahoma City, and Cincinnati. Morgan Properties, ranked as the third largest apartment owner in the United States by the National Multifamily Housing Council, sees this acquisition as a strategic opportunity to bolster its presence in the Midwest, where rent growth has been notably strong. This deal also marks an end to Dream Residential's service agreements with Dream Unlimited and Paul's Corporation, with a separation payment of $7 million US dollars to settle outstanding fees and wind down costs. Brian Pauls, who has been leading the REIT since June 2023, is at the helm during this transitional period. Morgan Properties, founded in 1985 by Mitchell Morgan and now led by co-presidents Jonathan and Jason Morgan, operates with a portfolio of over 100,000 units across more than 360 municipalities in 22 states. This acquisition not only highlights Morgan Properties' strategic expansion, but also emphasizes the dynamic nature of the multifamily real estate market. As they extend their reach into high-growth areas, it's a pivotal moment that underscores the importance of adaptability and foresight in real estate investment. The multifamily sector continues to present opportunities for growth and resilience, even amidst broader economic challenges. In a major development for the multifamily real estate sector, Elme Communities has completed the sale of 19 multifamily communities to an affiliate of Cortland Partners, LLC, for a staggering $1.6 billion in cash. This transaction is a significant step in Elme's plan of sale and liquidation, which was approved by shareholders at a special meeting held in late October. The sale marks the beginning of Elme's strategy to sell or dispose of all its assets, including 9 remaining multifamily properties and Watergate 600, with the ultimate aim of winding down and dissolving the company's business operations. Following the completion of this portfolio sale, Elme Communities announced a new loan agreement with Goldman Sachs Bank USA, securing a senior secured term loan amounting to $520 million. This loan, which matures in November 2026 with an option to extend for an additional year, is expected to be repaid using the net proceeds from the sale of properties securing the loan. Elme plans to return net proceeds from the portfolio sale, along with a portion of the term loan proceeds, to shareholders through an initial special liquidating distribution. This distribution is anticipated to be between $14.50 and $14.82 per common share, after accounting for repayment of existing corporate debt and transaction-related costs. Elme Communities expects to declare this initial special liquidating distribution later this year, with payment slated for January 2026, contingent on the approval of the Board of Trustees. Additional liquidating distributions are expected to follow as Elme completes future asset sales and fulfills its financial obligations. Paul McDermott, President and Chief Executive Officer of Elme, emphasized the company's commitment to maximizing shareholder value through the timely sale of its remaining assets, aiming to complete all sales by mid-2026. The sale to Cortland and the subsequent liquidation strategy underscore the dynamic and evolving nature of the multifamily real estate market. As Elme Communities undertakes this significant transition, it highlights the importance of strategic decision-making and adaptability in navigating the complexities of real estate investment. The multifamily sector continues to demonstrate potential for growth and resilience, offering investors opportunities even amidst the broader economic landscape. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.